started, I would like to welcome everybody back from the break for yet another much awaited keynote talk by Professor Arvind Subramanian, which will be chaired by the IGIDR Director and Vice Chancellor, Professor Mahendra Dev. Professor Mahendra Dev, over to you now. Thank you.
So good evening and welcome to the keynote address by Professor Arvind Subramanian. I'm happy to introduce him. As you know, Professor Arvind Subramanian is a renowned economist. He was the Chief Economic Advisor to the Government of India between 2014 and 2018. He is now Senior Fellow, Brown University's Watson Institute for International and Public Affairs. Previously, he taught at the Harvard Kennedy School and was the Dennis Weatherstone Senior Fellow at the Peterson Institute for International Economics. In fact, the Foreign Policy magazine named him as one of the world's top 100 global thinkers in 2011. You all know his contributions as Chief Economic Advisor to Government of India. He oversaw the publication of the Annual Economic Survey of India, which became a widely read document on Indian economic policy and development. For example, the 2018 survey had 20 million views from over 190 countries in its first year of publication. His contributions to the Indian policy making are well known. Among the major ideas and policies he initiated and helped implement were a simplified GST, attempts to tackle the twin balance sheet challenge, and creating the financial and digital platform for connectivity, that is the so-called JOM Trinity, charting a new fiscal framework and a universal basic income. Announcing his departure as CEA, the former finance minister, Mr. Arun Jaitley, wrote a Facebook post. Thank you, Arvind. So his award-winning book, Eclipse, Living in the Shadow of China's Economic Dominance, was published in September 2011 and had printed 130,000 copies worldwide in 4 languages. His latest best-selling book, reflecting on his time in India, of Counsel, The Challenges of the Modi-Jaitley Economy, was published in Penguin Random House in December 2018. The title of his keynote address is Peering Back to Look Ahead, Measurement and Prognosis for the Indian Economy. Yeah, he's been working on this, the measurement and all, last several years, few years. I was told he's also going to present some of his new research on this topic. So he will take about 40 minutes. We'll have Q&A for 20 minutes. So as Rajeshwari mentioned, you can write your questions during the talk or after the talk in the chat box. So now I request Professor Subramanian to give his address. Thank you very much.
Thank you very much, Professor Mahendra Dev. And IGIDR for inviting me. I'm really honored to be here to deliver this address. There are, so many terrific scholars at IGIDR who have worked on some of the issues that I'm going to talk about today. So I'm kind of doubly honored and also a little bit scared of presenting all this in front of people who know this probably much better than I do. It's also a particular honor to take part in this year's event because, as you know, we're celebrating the life and work of Subir Gokarn, who was such a great human being and such a terrific economist and policymaker. So I'm kind of doubly honored to be here. So today what we want to present is some new research that Josh Feldman and I have done, peering back to look forward from measurement to prognosis. And without much ado, let me jump right into it. And I, of course, look forward very much to your comments and questions. And Josh and I would be delighted to respond to them, at the end. So just by way of setting the context, the big issues of the day today are, is India back? And of course, the related question of, what is the likely potential growth? In fact, in today's Times of India, Poonam Gupta who's the Director General of NCAER and a terrific economist, has a piece on this. What is India's likely potential growth? And I think it's fair to say that there is a lot of optimism. I think there's one view which says that there are going to be few scars from the pandemic. The twin balance sheet challenge apparently is getting better. And so many believe that growth will go back to normal. Now, of course, but that begs the question, what is normal? And that's what I think, to get a sense of what is normal going forward, we need to have a sense of what was normal in India's recent history. And that's what Josh and I want to present today. So just to, again, I don't want to bore you with a lot of economic history, but I think in the pre-COVID period, one can identify, I think, three phases, as it were. The early 2000s to the global financial crisis, where, the world boomed, and of course, India boomed in particular at that time. Then the period after the global financial crisis to 2018-19. And then there was a 2019-20 slowdown, which I think raised people's, concerns about where the economy was heading. And so I want to just show you some numbers on these three distinct periods. So let's start with, the first period, the acceleration. So this is a chart, and I just want to spend 2 minutes on this chart because it's important. This will be the kind of charts that we're going to be presenting again and again. So let me just say that on this chart, we're showing the acceleration. So what we've done here is we've chosen the key macro indicators, and we're showing everything in sort of real terms, annual average. There are two periods. The blue is 96 to 2002, so kind of the pre-boom period, and 2003-10. I mean, you can change it by a year there. It doesn't matter. It kind of captures the peak of the boom. And the indicators that we show are, I want to be careful and specific here. They're basically macro indicators that capture either are or proxy for indicators of demand, exports, imports, investment, or they are indicators of macro supply side things like, what is the profitability of the corporate sector? So we show profits upon GDP. And of course, a third indicator that we show is, the financing of the overall economy, and that's the credit thing. Everything is in real terms, as I said, all annual average. So there are macro indicators that should capture the economy as a whole in various dimensions. And also we have confidence that all these indicators are actually, well measured, whether it's the IIP, whether it's taxes, whether it's trade, whether it's credit, which comes out from the RBI, or profits, which comes from the CMIE. And what you see, I don't want to go through every number here, but what you broadly see is, you see the boom, you see, the annual average rate of growth, no matter what indicator you take, goes, just surges in the boom period. Just to give an example, IIP investment, it was 6.5% per year in 96-2002. It shoots up to nearly 20% per year in the boom period. Similarly with credit, 9.3% in real terms credit growth pre-boom, and 16% during the boom. So this is the surge in macro indicators capturing the boom. And then, of course, for the period after the global financial crisis, we show 2003-10 to 2013-18. And you see that in every indicator, macro indicator, there's a complete bust. IIP investment goes from 20% per year, which I just showed you, to less than 4% every year. Credit grows from 16% in real terms every year to less than 5%. Exports collapse from about 15% to 4%. Tax revenues collapse and so on. So you see both the boom and the bust in all these major macro indicators on the demand side, on the supply side, and on the financing side. And then we now have new data. We have new data from the recent debt and asset survey. It's for 3 time periods. And what you see is that you see the same pattern of boom and bust. The time periods are slightly different because that's when they're measured, but whether it's asset growth or urban asset growth or rural asset growth, in real terms, you see the boom and you see the bust over broadly the same period. So we have new data that confirms this pattern as well. So the story so far is India has gone through a pronounced boom and bust, boom from the early 2000s to the global financial crisis, kind of bust from GFC to just before the pandemic. It created these balance sheet problems, which Josh and I called the twin balance sheet challenge way back in 2014. So then we get to this, what we would call the Solow puzzle. Robert Solow famously said, if you remember about PFP, you can see the computer age everywhere but in the productivity statistics, because he said you don't see the growth of the computer age. So the parallel question we ask is, can you see the boom bust in the national income account statistics? And it turns out that, it's a bit mixed. It depends on which statistics you use. So the question is, where's the boom? Now, I want to hear just, again, by way of reminding all of you, you know this better than I do, there was the old series with the 2004-5 base. There's the new series with the 2011-12 base. Then there was the old series using the 2004-5 base. Then the National Statistical Commission submitted its report. Sudipto Mandal and Bhanu wrote this about the GDP, submitted in 2018. And of course, then the new series, if you remember, in late 2018, 2019, or after I had left government, the new series was backcast for the 2004-2011-12 period. Now, this is not the forum to get into all the methodological issues. And in any case, it's been done by so many excellent scholars at IGIDR itself. Professor Mahendra Dey, Professor Nagraj, Rajeshri, many others, Professor Goldar, Bhanumurthy, the late T.N. Srinivasan, Sebastian Morris, Pandya, all of you have worked on this. And so I'm not going to address the methodological issues, but just to kind of show you the implications of what the numbers are showing us, telling us. And that's what I want to focus on today. So the old series, showed growth going in the same 2 time periods for which I showed you the macro indicators. It did show a reasonable surge, a reasonable acceleration, 5.5 to about 8.5. That's kind of reasonable. And in fact, the National Statistical Commission, actually, when it submitted its report, it said that the numbers from the old base, if anything, understated the boom. And so they actually hiked up the estimates for the 2004-5, 11-12 period by about 0.5 percentage point. So they said, in fact, the old statistic, and this was done very carefully. And of course, as we know, this report never saw, or at least the recommendations were not accepted. So the old series and the NSE series showed a boom. If you look at this, 5.6 to 8.6, that's a real boom. But what happened, of course, when the series was back, when the 2011-12 series was backcast, there was a serious downward revision of historical data. One often thinks of countries want to show that they're doing better than they actually are. So typically, GDP estimates tend to be on the high side, but here maybe one of the unique cases in history where official statistics said no, actually growth was lower. Of course, it was lower in the past, but it was lower, and there were some really serious downward revisions to the backcast series. And you see that, for example, in 2010-11, almost a 2 percentage point reduction. Similarly, in 2007-8. So there was we call this the Great Revision. And then essentially what happens is that in the new series, that acceleration is kind of taken away, and we get more like a steady increase in growth rather than the acceleration. So the sizzle, the boom kind of is kind of taken away by the new series that's measured. And in some ways, I feel a bit guilty about this, that a lot of the GDP debate focused on the period after the revision 2011-12, but we've kind of forgotten that there was also a major revision of the historical 2004-5, and this is kind of one consequence where the macro indicators show a boom, and the new series shows that there was a steady increase, but certainly no boom. Then, of course, we say, where's the bust? Just let me remind you, this thing really collapsed. As you can see, all the macro indicators, but in the official numbers, there's no, it's kind of growth continues on, between 2010, 2013, 18. This was, of course, the subject of a lot of the work that all of you have done, many of you have done, and the work that I presented also in 2019. Just to remind you, collapse, annual average rate of growth, all these indicators drops in some case by 10 percentage points per year in real terms, all these major indicators. And of course, we see, the official story is that growth continues at a steady, cheery pace. Now, what happened in 2019-20? I want to just show you something because this is really stark. The official growth numbers you should see on the left-hand side, showed a fairly sharp decline in growth. So I think the 2019-20 number on the left-hand side is what first started raising people's real concern about where the economy was headed. And that decline somehow also comforted people or reassured people that actually, measurement was fine, because see, the official numbers are showing a decline, and we see that in the economy. But what I want to show you with the right-hand side chart is that 2019-20 GDP number of 4% is highly misleading, because the economy basically collapsed. It didn't decelerate in 2019-20, it collapsed. Look at all the macro indicators, other macro well-measured indicators, they're all in a negative or deeply negative territory. Real credit declined by 1.5%, exports collapsed, the IIP consumption collapsed, tax revenues, imports, everything was in negative territory. So in 2019-20, there was no deceleration, but a collapse. So in a sense, this partially answers the question of when COVID hit, why was the hit in 2020 so bad? The partial answer that Josh and I have is that it came and affected an economy that had already experienced a very serious decline and a collapse. So to put it somewhat sharply, there was a pre-COVID collapse even before the COVID collapse of 2020. This chart on the right-hand side, this 2019-20 number on GDP is kind of really, I don't know how to say it euphemistically, I think it was very misleading, but it had just enough of a flavor of decline for all of us to think, yes, it's well measured because it's showing a decline, but actually it was actually highly misleading because it failed to capture the complete collapse of the economy pre-COVID. Remember, this was the post-ILFS period. This is the period about which Josh and I wrote a piece in 2019, a paper saying that the economy was in the intensive care unit in December of 2019, and it turned out that it really was in the ICU. Now, just to summarize the growth puzzle, indicators, all the macro indicators suggest boom, bust, or boom, sharp decline, and collapse. But in the GDP numbers, what you see is kind of a kind of high and steady-ish growth with some decline in 2019-20. So it's actually a completely different story that you see from the macro indicators. Now, the new part of the research that I'm going to show you now is, and it's something that's not been, at least I've not seen remarked enough, which I'd like to alert you to, is what I would call, we would call the consumption puzzle. So if you think whatever happens to GDP production measured, overestimated, underestimated, there must be some consequence on the expenditure side because of the identity y equals c plus I plus g plus x minus m. India measures y from the production side, and it measures various components on the demand components on the right hand side. I think we have reasonably solid data for I, investment, government, exports, and imports, but consumption has been traditionally difficult to measure. It tends to be a residual, but the identity actually gives us new clues about the GDP measurement itself, and that's what I want to talk to you about today. Is there evidence that C is consumption is mismeasured? So just to give you, let's take two kind of iconic items of consumption. The upper middle class and the upper class, they buy cars, and the lower middle class and the lower class, let's say economic class, they buy passenger two-wheelers. So I'm just abstracting just to give this as an illustrative example. I'm going to show you more macro numbers, and you see the same pattern of acceleration and decline. And of course, in 2019-20, you also see the collapse in these consumption indicators, which I'm not going to show you. But I want to show you that passenger sales pre-boom 10% per year, boomed almost 20% per year. 2013-18 post-global financial crisis collapsed to 2%. Similarly, two-wheeler sales, it's less marked, but it's still very sharply there, 10% to 13% to 18% to 8%. So you see the boom and the bust in the private consumption numbers. Now, what about in the macro aggregate consumption data? So here I'm showing for the same time periods the old series, the IIP for consumption, which is a proxy, a macro proxy for consumption. And I stress it's a proxy, it's not the actual thing. I think, of course, there are other things going on. And then there's the NSS data. Now, I don't want to get into each of the individual numbers and the levels, because I think we can endlessly debate them, as we should. But what I want to show you is that exact pattern of acceleration and deceleration. You see it in the iconic car data, two-wheeler sales data, but you also see it in the macro, other macro consumption series data, whether it's the old CDs, whether it's the IIP for consumption, or whether it's the NSS. You see the sharp increase and the sharp decline in aggregate consumption. Now, so this is, I think, maybe a small insight that I want to share with you, that when the GDP got revised, consumption had to be revised on the expenditure side, because everything else really can't be, they are hard, reliable data. So in a sense, consumption bore the brunt of the revisions in GDP. And what you see is, big revisions in consumption, much bigger in percentage point terms than the revision in the GDP, because it's simple. If you change Y by 1 absolute rupee, you change C by 1 absolute rupee, but the percentage change in C is going to be much greater because C is less than Y. And what you see is, for example, look at 2006-07, the consumption was revised down by 3.5 percentage points in 1 year. Similarly, 2007-08, almost 2 percentage points. 2010-11. So the revisions in GDP necessitated and forced a major revision in consumption, and which revisions also kind of jar relative to the acceleration deceleration story that all the other indicators of the economy are saying. So, and this is kind of the stunning thing I want to show you, that now if you look at the official data, it says not only did private consumption not decelerate, it accelerated in the post-global financial consumption period. So two things I want to emphasize here, that, or takeaways from this, is the consumption story that you get is one of, a boom, continuing boom, and accelerating consumption. Whereas the macro indicators show, boom and bust, acceleration and deceleration. And the second insight is that this pattern in consumption is because of and derives from the changes in GDP. So if you change GDP, this will necessarily happen, and it will give you something that's completely at variance with our understanding of what the economy did. For example, if you just compare this with the car sales, it's exactly the opposite story. Not, steady growth and acceleration, not boom and sharp decline, but steady growth and acceleration. So in some ways, the consumption, if you think of this as kind of forensic economics, the clues are as much in consumption as they are in GDP, or put it differently, the consumption numbers give you a clue about the reliability of the GDP statistics. So just to kind of say here, the official data, and remember, this is all the macro indicators that I've been telling you are all official data. So this is not a kind of criticism of all official data. It's just that some official data that we think are independently and reliably measured, they tell a very different story from the national income accounts data. And just to summarize, the macro indicators show a boom, bust, collapse, but the national income data show steady GDP growth, no boom, decline, and collapse, and accelerating consumption, not a collapse in consumption. And I want to remind you that that mismeasurement problem was particularly serious in 2019-20, when every indicator was showing, major indicator was almost showing negative to very negative growth, and the aggregate GDP number, while showing a decline, still showed a very decent growth of 4%. So this is kind of the measurement part. So we look for what is normal. Now, so just to give you a fact, I think this is the official growth story, a high and steady from about 2003 onwards. And then I want to, there is an alternative growth story where the red dotted line says, actually the boom was much boomier, as it were, and post-global financial crisis was very different from what the official indicators suggest. And I want to just be cautious here, is that for the pre-2011 numbers, we actually have alternative semi-official data done by Indian scholars themselves and Indian officials, which is the old series and the National Statistical Commission. And this is just reproducing their numbers from before 2011-12. And after 2011-12, as we've argued and as I've tried to show now, it's a very different story that the macro indicators tell. Obviously, no one has actually measured the new numbers based on this, but it seems like it was, much below the official numbers. And I want to emphasize that there's kind of uncertainty. It's not a hard and fast number that I'm saying this is the thing, but we know based on all that I've shown you now, the macro indicators, the consumption indicators, that our intuition about the acceleration and the deceleration and the collapse just don't show up in the official numbers, and a much more plausible story is this story in the red dotted line. Now, so what are the what is the kind of normal growth going forward? So, looking back, if you say, and that's kind of what Poonam Gupta was arguing today, you see, when as economists, we know the dirty secret that when people calculate potential growth going forward, it's essentially some very pseudo-sophisticated, backward-looking weighted average growth rate. Whether you take Hodrick-Prescott filters, etc., it's basically a sophisticated, historically weighted average growth rate. And so, if you kind of buy this story about all the indicators are saying that the actual growth story was something like the red dotted line, then the pre-COVID growth was closer to 4% than the official number of 7%. And so if you think going forward, that's the normal growth, then you get a very different estimate of the potential. Now, that's just based on just mechanically looking back and extrapolating that forward. Then, of course, you have the COVID shock. And, I'm happy to answer questions, take questions in the Q&A. There's a lot of now new literature on this, which says that potential growth has been affected by COVID in at least 3 significant ways. There's the human capital story, because, for 2 years and still children are out of school. The labor market has been, Mahesh Vyas has been showing that employment has been well below pre-pandemic levels. So there are kind of serious scars from COVID. Then, of course, there's the small and medium enterprise story, which, as we know, has borne the brunt of 3 shocks in the last 5 years. There was a demonetization shock, there was the GST shock, and the COVID shock again disproportionately affected the small and medium enterprises, because we know that COVID affected services more than manufacturing, affected retail, restaurants, small businesses much more. So there's a scar to the small and medium enterprises. And of course, there's a broader point which is being made all around the world, that, that because the post-COVID world is going to be very different, there has to be a reallocation of resources. Just to give one example, commercial real estate, for example, in the US is now going to be significantly underused, because people are not going to have show up in offices like they did pre-COVID. And of course, you could think of various such examples, much more digital-based over contact-based activity, which will require a serious reallocation of resources. So all of these are likely to, affect potential growth. I mean, I don't want to completely just point to one side. Maybe there are also things about the post-COVID world that are going to give new opportunities. We've seen the rise of unicorns and entrepreneurship in the digital and technology sectors, where there seems to be really a very exciting new activity going on. So maybe that's going to bump up potential growth, at least in some sectors, high-tech sectors to some extent. But broadly, if you buy this story that, the pre-COVID potential was much below what the official numbers say, and then you have these major COVID shocks, then you're looking ahead at potential growth, which is kind of not close to the rosy estimates that are now being touted by everyone. Now, this is not, a story about data for data's sake. Of course, we are, as academics and researchers, we want to get this right, but it matters deeply because, data drives diagnosis, a diagnosis drives policy. Then, of course, if data are mismeasured or unreliable or cannot be relied on, then both diagnosis and policies can be misguided. And just to give you an example of the diagnosis problem, we really have, if you follow the kind of commentary in India in the last 2-3 years, we have a story which Sajid Chinoy says, which basically says that consumption has sustained growth in the post-global financial period. And then there are others like Ratin Roy, Naina, and Harish Damodaran, who've been writing saying consumption has collapsed. Oh my God, consumption has collapsed. Where are the sources of growth going to come from? And really, a part of this comes from, what measure you're going to look at. If you're going to look at the official numbers, consumption has, far from having collapsed, as I showed you, has been accelerating. So the question is, what are you talking about? But on the other hand, if you look at the more realistic numbers, you do see that consumption has come down very sharply. And while it may have propped up growth to some extent because investment and exports collapsed, it's nowhere has the role that some people are making it out to be. So that's kind of a good example of the diagnosis problem. Then you have the policy problem, which really, and I say this as someone who actually, while in government, saw this very, very, I'm speaking from almost personal experience, because, if you think that growth has been rapid and steady, then there is no reform urgency. And in fact, I used to have this, I had this discussion with Mr. Arun Jaitley a few months before he sadly passed away, that, had the data been, shown the slowdown, the urgency to act would have been different. And also in the 14 to 18 period, there were all these discussions about, fiscal and monetary policy, how supportive they should be. And of course, if we thought growth was, really steady and high, the case for supportive fiscal and monetary policy were correspondingly weakened. And I saw that too in action. So if growth has been rapid and steady, you don't need terribly supportive policies. You don't need to act urgently on the other reform measures like the twin balance sheet challenge and so on. But on the other hand, if the pattern has been boom, decline, and collapse even before COVID, then the policy implications are very, very different, because then we need very serious remedial action, especially on the reform side. And so, the looking back is not just kind of intellectual, technical exercise for its own sake. It matters deeply, deeply for, how we think about, supporting the economy or reform the economy, and the urgency with which we act going forward. So let me conclude. I'm sorry for having taken up so much of your time, just to say that reliable data are absolutely essential for correct diagnosis and effective policy response. We need a good and reliable story about recent Indian economic history that's consistent with all that we see around our intuitions, all the macro indicators, the consistency and so on. And the corollary, the policy corollary, we would say, is that without strong policy actions, in fact, what Josh and I say is that we need some fundamental improvements, not just in terms of tinkering with one policy or the other. We basically think that there needs to be fundamental improvements in the policy framework and the process of policy making, which we call the policy software. And just a couple of days ago, we have a new paper in Foreign Affairs magazine where we talk about this defective policy software, which includes things like rule of law, consistency of actions, data integrity as a key underpinning to that, not having arbitrary action, creating a climate of consistency and level playing field between investors, so that private investment can come back. Because as we know, unless private investment and exports come back, we cannot have sustained growth in the economy going forward. So the policy, what we call the policy software, which is not just one policy here or there, but the whole framework and the process needs significant improvement if India is to get back to the kinds of growth rates that we saw prior to the global financial crisis, and that definitely has eluded us post-global financial crisis by a significant amount, which unfortunately the data are not, some of the official data don't seem to show. So let me stop there. Thank you all for listening. Sorry if I bored you, and we'll be happy to take questions.
Thank you, Professor Subramanian, for excellent analysis on measurement and prognosis up to 29-20. A lot of food for thought. This consumption puzzle and 2019-20, your analysis is very interesting. First, question is on consumption expenditure. As you mentioned, Sajid Chinay said, consumption sustained growth when investment rate declined, particularly up to 2016-17 or 2018. After that, of course, as you mentioned, NBFC ILFS scam happened and has reduced the liquidity, and also consumption growth also declined. So that is the growth in GDP declined from 2017-18, 8% to 6.8, and then 4%. If you believe the official figures. But on consumption, this national account statistics and national sample survey. In any country, you have differences between the two. But in India, in the 70s, it was 10% difference. But the latest leaked data showed that 70% difference between NSS and national accounts statistics on consumer expenditure. So there is something wrong. Either NSS is wrong or the NIS is wrong. Of course, as you mentioned, it's NIS, it's a residual. But household data also, nowadays there are problems. We have investigators problems and other things. So what's your opinion on consumption, puzzle?
Yeah. So Professor Nandev, a great question. And that's why I would be at pains to emphasize that I don't want to compare the levels of one or the other, because that's just a huge debate that's gone on. What I want to emphasize is the pattern that you saw between all the other indicators of up and down, whether it's the old series, whether it's the NSS, whether it's the IIP of consumption, that pattern, you see almost the opposite pattern, the time pattern in the official data. I don't want to get into, which is, how much is the wedge between NSS and national income accounts, because that's a completely different and, a whole field of inquiry, which, I'm not the expert on. But all I want to say is that the time pattern are so different, and it seems like all the other indicators, whether it's NSS, car sales, or the old series, the IIP, they seem to be giving us a time pattern that's more consistent with what we know about the economy than the national income accounts. So that's what I want to emphasize more, the pattern over time and how implausible that pattern is for the national income accounts, without wanting to now at this stage get into any debate about the individual numbers for individual periods.
Thank you. My second question, last one, is on medium-term growth. You're saying normal is around 4% in the last few years per annum. This can reduce further in the post-COVID period. Already 2019-20 and showed. But you're also saying that it could be 7% if software problems are resolved. So, but do you think they can be resolved? For example, the export protection, the tariff protection and those kind of issues.
Yeah. So again, a great question from Mandev. I think that certainly one of the things that we talk about in this Foreign Affairs article, and it's also some work that I did with Soumitra Chatterjee on India's exports. Let me just spend 1 minute because it's a very important question. The current strategy for exports seems to have three components, right? One is a reversal of import tariff protection because tariffs have gone up. And Soumitra and I showed that about 70% of imports, there was about a 5 percentage point increase in the average tariff, and it affected about 70% of India's. So the first prong is of this kind of Atmanirbharta is raising protection. Two is much more kind of industrial policy, which is giving subsidies to selected sectors. And three, the third component is actually staying out of international integration agreements, especially in the dynamic region of Asia. So the question is, can this three-pronged strategy actually boost exports or not, which was your question. And our feeling is that, I mean, it's almost as if these three prongs are highly unlikely to generate this. And let me give examples of each of these. So clearly tariffs have gone up, and I don't mean to suggest by any means that they've gone up to the levels that we saw, in the pre-reform period. They were much higher then, much more arbitrary, much more quantitative restrictions. So it's not the same regime, but it is a reversal of a 30-year consensus of steady decline in protection. That's been reversed. Now, what does that do? I mean, if you raise tariffs, we know from the theory that, input costs go up. If you take, for example, clothing, which is a highly import input intensive sector, then if you raise tariffs, then your cost of production is going to go up, and your exports are going to suffer. But the deeper problem, of course, we know is that an import tariff is an export tariff. That's the Arba-Lerner symmetry theorem. An import tax is an export tax, and so that protection is especially going to be difficult. Now, when you combine that with the third aspect, i.e. staying out of international agreements, the two play off each other. So just to give you one example, suppose investors are fleeing China because China is becoming uncompetitive, wages are rising, or that China is becoming very arbitrary. That investment will want to locate itself in a place where it says, we can use that as a launching pad for exports. Now, coming to India maybe is a biggish market, but those investors don't want to come to India just for the Indian market, because actually the Indian market is actually much smaller than people think it is. They want to come for the export market. But if you're not part of international supply chains, your cost of inputs are going to be very high. If you're going to want to export to the most dynamic regions in Asia, well, you're left out of those free trade agreements, so your access is going to be much worse. So that's why this strategy. And then the third strategy of the PLI, the production-linked incentives, I think Shankar Acharya wrote a very nice piece on this about a year ago. I think the one thing I would add to that is, these PLIs are effectively, most of the beneficiaries are kind of tech-intensive and capital-intensive sectors. And if we want inclusive growth in India, we need labor-intensive, unskilled labor-intensive growth, which, the PLIs, they're giving some, but that's not the focus and the thrust. Our clothing, footwear, consumer products, those are the ones that need. And there you need cheap inputs, you need access to markets, and you need, easy, the cost of doing business, the cost of trading have to be very easy. So that's the sense in which it's not, we think it unlikely that this strategy will deliver, very rapid export growth.
Thank you. So we have in chat box some questions. Dr. Abhay Pete, I'll pick up some. Dr. Abhay Pete said, in this in charting a reformative dynamic path, the role of effective cooperative federalism is important. So in this current conflict-ridden polity. So care to comment on how do you improve the extent?
Professor Pete, I agree 100% with you, 100%. Now, I didn't mention, but if you read our piece and our earlier pieces, for us, one of the key components of the policy software is trust between the center and the states. So let me make a bigger point, and then I'll come to the excellent cooperative federalism point that Professor Pete made. You see, more broadly, we need trust between the government and private investors. We need trust between the government and citizens. And in a large country like India, and this is where Professor Pete's point is very important, we need trust between the central government and the state governments. Now, why is it important? I think it's just important in just so many ways. And let me give you two examples. Let me give you a kind of a positive example and then a kind of a less positive example. I mean, let's take our goods and services tax, right? I mean, for all its initial design flaws and implementation, we see today that, the GST, I have full confidence that going forward with all the changes that are being made and the fact that even revenues are coming back despite growth being a relatively, or rather revenue performance is exceeding growth performance. So maybe some improvements are already happening in the way GST is being implemented. But in the long run, we know it's going to be effective, but it's going to be effective because of cooperative federalism, because of the way in which the states and the center came together, both to design and implement that. I mean, that's a thing. Now, so that's, I think, and that happened under this government. I think it's important to remember that this government did the GST, and under Arun Jaitley's stewardship, we got this really fantastic bout of cooperative federalism. But let's take other examples. You take agriculture, for example, right? I mean, lost in all the debate about agriculture is the fact that, no one denies that agricultural reform has to take place. Nobody denies that. But we know that in India, agriculture is, even though it's a state subject, it's regulated both by the states and by the center. The center gives fertilizer subsidies, MSP. The states do a lot of the procurement. They give the power subsidy. They do the irrigation, etc., etc. So any reform of agriculture will have to happen when the states and the center come together on a reform strategy. So I think agriculture, what happened is a powerful reminder of Professor Pete's excellent point that unless you do cooperative federalism, you can't solve many, many issues in India. Let me give another example. The power sector is another example where, again, the center and the states both regulate this. And unless the center and the states come together, power reform in India is going to be, and I can carry on, but the nub that cooperative federalism is key. It's an integral part of the policy software that Josh and I have spoken about, is a point it's a fantastic point and a point that's very well taken.
Yeah, there is a question from Rajeshwari. So there has been no attempt to correct the measurement problem in the NAS, and that the GDP series and its components are being used to show that economic recovery now is strong. So to what extent, therefore, can we believe this narrative about strong recovery? What's your sense of the kind of recovery the Indian economy is experiencing now?
See, let me say, see, and really, I want to be a little bit careful. I think as an academic and serious researcher, we need to be careful here. I want to be careful here. Let me just say up front that all that I've said here stops at 2019-20. I've not said anything about the measurement in the COVID period. And I haven't said anything for two reasons. One, I haven't studied it. to be honest. Josh and I have not, studied the measurement part of this. So I don't want people to say, what about now? To be honest, we haven't studied it carefully. And the second thing, of course, is that one generally has to be careful about, how measurement and the relationship, the economy itself undergoes a lot of structural change in this. And then the connection between measurement and the economy also could undergo rapid change in such extreme events. So one has to be very careful about that. But having said that, you take the IIP number, for example, that's been, that we know is kind of, it's kind of easier to measure. And for that matter, even the GDP measure, if you look at the level today, the GDP is barely back at the pre-pandemic level, and the IIP is still below the pre-pandemic level. So I think we are mistaking, or there's a risk that we mistake a natural bounce back from a big decline, which is happening, and which is very good. I hope more of it happens. But if you look at the levels of some of these indicators, I think they're still not back. So I think it's far too early to, if I were a policymaker, I'd be very cautious about celebrating the numbers, which are still, let's be honest, fairly weak. Compared to the pre-pandemic level. If you look at IIP consumption, IIP manufacturing, especially IIP consumption, it's well below pre-pandemic levels. So I think, but on the other hand, as I just said, tax revenues are doing well. I think maybe that's a harbinger, maybe that, things will improve going forward. But what I would say is that the recovery is still, a work in progress, and we need to see. Second, that we still don't know what it all means for the post-recovery period, that we still haven't entered into. And the aim of this presentation was to say that whenever we get, whenever we come out of the recovery and COVID and are back to some semblance of normal times, the kind of potential or normal growth there has to be seen in the context of what happened between 2013 to 2019-20 on a more, factual and realistic assessment of that period than perhaps what the official numbers might tend to suggest.
There is a question from Ashima Goyal. So as an insider at that time, what is your view on the reason for the sudden deterioration in just the national income data?
Sorry?
As an insider at that time, what is your view on the reason for the sudden deterioration in just the national income data?
Well, I've written that, the first, the revision of the series was, the 2011 thing was in part in large part a kind of technical issue, not a political issue. At least between 2011 and 2011-12 and 2017-18, those numbers I think were much more a technical issue, and the way deflators were done, the extent to which the informal economy was measured. But thereafter, after 2018, I just cannot say, because I wasn't there. At that stage when we were there, we certainly spent a lot of time and effort trying to see whether, what components of the technical aspects could be improved. But remember, a lot of what I've been speaking today is also about the backcasting, is about, therefore, the implied changes for consumption, which happened, after 2018, and I wasn't there, so I don't know. I can't speak to that question.
Yeah. Somebody said about the stock market. There is a disconnect between stock market and the real economy.
I think that three things to say about that. I guess again, I'm not the expert on the stock market. Firstly, we know that valuations all over the world have been elevated because of cheap money until very recently. Now, of course, the macro outlook in the US and the Federal Reserve policies are going to change going forward. But certainly until very recently, we've had a lot of liquidity around in the world. And there's no doubt that that has contributed to elevated asset prices, stock markets all around the world, including India. That's point number one. Point number two is that I think even allowing for that, the Indian stock market, at least when I presented a version of this at Brown University in October, early October, and at that stage, Josh and I, when we looked at it, the Indian stock market had outperformed other stock markets, and part of the reason for that, of course, is this whole first. The kind of composition of the Indian stock market, we know, is weighted towards kind of big firms, commodity-based firms, and also technology-based firms. So to that extent, stock markets reflect the Indian economy less because of the weightage of all these, very special and, very tech-intensive, capital-intensive, commodity-intensive sectors in the stock market, and therefore, some of those sectors have actually benefited from COVID. The whole rise of unicorns, the tech sectors have actually benefited from COVID. So that also reflects partly. So easy money globally. The nature of the Indian composition of the stock market, the nature of the COVID shock, all reflect. But it must be said that it would be a kind of policy mistake or an analytical mistake to infer anything about the broad-based and diverse Indian economy based on how the stock market does. And we've seen a lot of evidence on that in our employment after COVID. Mahesh Vyas has been documenting that in all the data that I showed about consumption. So I think we should keep all these in mind when we think about why the stock market is doing well and what its implications are for the economy.
Yeah, one question is on your twin balance sheet. So what do you think now? The NPAs have declined and the corporate has done well during COVID.
Yeah, so I think it's a very good question again. I think it's one of the if you think about it at one level, it's kind of bizarre that you get a massive COVID shock, and that actually improves the twin balance sheet challenge. At one level, it's a bit bizarre to even put that, so next time you have a balance sheet problem like this, we need a kind of massive COVID shock or GDP shock. But kind of lightness apart, I think a couple of things have happened. I think one is that there's precisely because the COVID shock was a disproportionate shock which benefited some big firms, the resource-intensive firms, the tech firms, and so on. I think that helped profits, and so that certainly improved the financial position, at least of the big corporates, but at the expense of the labor market. So that's why, one has to be a little bit careful that, profits have indeed gone up, financial position of the big firms has indeed improved, but what it means going forward, I think is a bit of a question mark, is going to depend upon the overall state of the economy. That's point number one. Point number two is that obviously, of course, some of these big firms have also benefited from the stock market boom. So they've been kind of substituting equity for debt, and that has also improved their financial positions a lot. And I think we should keep that in mind. But I think, and then, of course, the last point I would say is that there is still the open question of the SMEs, they've been very badly hit. Of course, they are less, compositionally, they account maybe for less of debt than the bigger enterprises, but they still account for a fair amount of debt. Their position, we need a little bit more clarity of that position going forward. And the last point I would say is that, we know that in the last 3-4 years, while overall credit has been, very weak, credit for consumption has been very high. So it's what we need to now monitor is, to some extent, the twin balance sheet problem maybe has come down, and we should look at that. But other balance sheets are getting stressed. SMEs, consumers. I think we need to be watchful about that as well. And also I think that we should also remember finally that the levels of NPAs, while they have come down, are still high. I mean, in the public sector banks, they're still in excess of 10%. And therefore, whether it's bankruptcy, whether it's bad bank, we shouldn't lose momentum on resolving that part, because directionally there's improvement, but the levels are still high.
Last question is, the inflation, will it affect the post-COVID growth?
Yeah, I think that, again, that's a great question. Remember now, this whole inflation thing is now, firstly, it's becoming a global issue, right? I mean, inflation is high all around the world, and therefore, policy responses around the world are going to change, and that's going to impact, liquidity and capital flows to countries like India as well. Now, in the case of India, there's no question that, inflation levels are elevated. Of course, they are, we do see this big divergence between input prices and output prices, because wholesale price inflation is very, very high, but core inflation and CPI is much lower. And frankly, I think that let me say two kind of analytical points on this. Yeah, one is that in places like the US, the worry is also that labor markets are so tight because quit rates have been very high, that the feedback from wages back to prices, and therefore the unanchoring of inflation expectations, is actually a real concern. In India, if the CMIE data are right, labor markets are very soft. So in that sense, the unanchoring of expectations from labor market-based, pass-through mechanisms, wages, prices, I think are going to be less there. So finally, I think it's really going to depend a lot on how the RBI responds. And let me make a kind of a slightly controversial statement. I think in India, the social consequences of high inflation are quite adverse. I think both society and politicians are kind of sensitive to high inflation. And I've always felt that makes the task of the central bank in India actually easier in some ways to address high inflation. So my sense is that based on all these things, both the central bank and the government and society at large, I think, have a preference for not having very high inflation. And I think that will get reflected in policy actions, both by the center and by the RBI. So I'm kind of cautiously optimistic that policy will respond effectively to over some medium term, to make sure that inflation and inflation expectations don't get out of control.
So, Professor Arvind Subramanian, thank you very much for your excellent talk, and also the great interaction, like the argumentative Indian, it's quite a good interaction. And then over to Rajeshwari.
Yes, thank you so much. On behalf of the MFC Organizing Committee, Dr. Subramanian, we want to extend a heartfelt gratitude for a really thought-provoking and insightful session. And as Professor Mahendra Dev said, you've given all of us a lot of food for thought. I would like to just say that we would love to have you over on the campus. We'd love to host you here in person, as and when travels get safer and we are all in a situation where we can all meet in person instead of virtually. But thank you so much for taking all the time to answer the questions. I would just request all the participants to please switch on their videos so that we can take a quick snapshot to remember this nice moment. And I'll let you know when the picture is being taken. Thank you so much.